Welcome to the Dividend Talk podcast, episode 66, September Dividend Hikes. Hey, European DJ, we're back another weekend. How are you?
Hey EMF, well, it's Friday night. Can't wait for the weekend, but I'm really happy that we have this podcast now. If you ask me how I am, I'm just knacked. Was a tough week at work. Can't complain. Had a business trip for the first time in almost 2 years, but I need a weekend to recover. How about yourself?
By the sounds of it, the company credit card must have got a bit of a bashing.
No comments.
Enough said. Hey, I'll be going to Italy soon, and my company will certainly pay for the privilege. But yeah, no, my week same as busy. We're into the weekend now, so I'm looking forward to a bit of chill out time. This time next week, I'll be sitting in the sunshine, relaxing. So I'm looking forward to that. But hey, let's talk about some news and China. China again. China's in the news. It seems to be getting all angles seem to be coming on China at the moment, doesn't it? They're cracking down on cryptocurrency. They are. They have this Evergrande having issues making sales and all this, and then you have the CFO of Huawei in court over bribery claims and stuff. So it all seems to be happening in China at the moment.
Well, it seems to be a perfect storm. So I bought another 6 shares of Alibaba today at $145. So I don't mind this. I mean, I don't really have a strong opinion about what's happening in China. I mean, if you really ask me about it, I think actually that the Chinese government is doing a little bit good here. You know my opinion. I think in America, with all the money printing and everything, we don't have a free market anymore. The airlines were bailed out, the cruise lines were bailed out, the banks were bailed out. So if anyone talks to me about that America has true capitalism, then I don't buy that anymore. And if for instance China let Evergrande just go bankrupt, for me that's already a stronger sign of modern capitalism than what we see from the United States. I know this is a very European view. Our American listeners might not agree to this, but it just shows like how dominated the market is by governments, like also in Europe, in the US, and we don't really have free markets anymore. I'm not long enough around to judge whether they actually have ever existed. I'm investing from after 2008, and since then there's already money printing going on. So with that having said, I think it gives me opportunities for a company like Alibaba. I have an average buying price of $186, so I'm 20% in the minus. Full disclosure here, but I love the company at these prices. I'm not so too concerned about their business. They pay the dividend back to the government of several billions. Of course, I see it kind of as an something that I consider in my valuation, right? Just considering like 1.5, 2 billion per year in dividend going to the Chinese government, and that's the discount you need to calculate on it.
Yeah, I mean, I've spoke before about the risk I feel of investing in China, but those risks don't go away, right? But I'm almost at the point now where it's been bashed so much that this saying, "Boy, when there's blood on the streets," and
Yeah.
I'm almost getting to that point where the risk or the reward will outweigh the risk. Again, as I said, I bought some Alibaba, I think about $160. So again, I'm in the minus, but it's only a small percentage of my portfolio. I'm not going to buy any more unless it gets closer to 100. Um, but I certainly think that there's so much negativity at the moment that it will pop at some stage and it'll bounce back up. Particularly with the likes of the cryptocurrency news. Like, this is old news. This has happened in 2011 or maybe 2017. So it's happened before. They've done it a couple of times. So it's nothing new, and it's come back every time since. So it's just interesting to see that the constant news in the Western world is about China at the moment, and we're pretty much ignoring all the woes and all everything that's going on In America, it's almost like it's a mask, and it's waiting for the West to pop by just focusing on China.
Yeah, that's interesting, and I think for us as investors, specifically German investors, the elections are way more important. I think because if they want to introduce a wealth tax or something like that, I think you're more screwed than what happens over in China.
Of course, the German elections are probably the most important in Europe.
I think so, yeah, and it's the end of an era of Angela Merkel. So it will be really curious to learn what that will do to the European relations, also with France and England, and And by the way, the Brexit that they can't get gas at the moment right now. Oh man, they're screwed.
Brexit has turned into a bit of a shit show, isn't it? I mean, but look, we knew there was going to be pain along the way. Europe were never going to make it easy. They were never ever going to allow the UK to leave and let them come out smelling of roses, because then everybody would want to leave. So this was always going to be expected. Maybe not as we couldn't predict that they can't get gas, but there was always going to be something. So it hits closer to home to Ireland, because anything that affects the UK usually trickles their way. So I
Oh.
can't laugh too hard at our UK counterparts.
Good. Well, hey, let's then look at some more better news then, because September is typically a really great month for dividend hikes. There are many, many companies that announce their dividends around this time. So in Europe, it's typically around April, May with the annual reports,
Yeah.
or February, let's say. But there are quite some companies, like US companies, that increase their dividends around this time, right? Just after the summer. And yeah, let's talk maybe about the first one, McDonald's.
Yeah, and look, I have to say, like, we are dividend growth investors, and sometimes feel that in the community we don't focus enough on the growth part. We tend to forget this, and what we're seeing here is that I think we have 5 or 6 companies, top quality companies. Every single one of them are quality companies, and their growth has been exceptional in terms of dividends. We have here the 5, 10, 3, 1 year dividend growth rates, and they're all pretty high. And as a dividend growth investor, I think it's important that it is an important metric for me. So McDonald's, it's not a company I own. It's a company I would love to own. I hope it seems too expensive. Are they a fast food chain? Are they, I don't know, are they more a REIT or a real estate business? You could argue it's a bit of both, but there's no doubt that it's a top quality business. Their latest increase was what, 7%, which if you look at their history, it's about average compared. So the 3 year dividend growth rate is 8, and then it's normally around 8. So between 7 and 8 is that. So they're right on par with where they normally increase their dividends. The payout ratio is quite good, I believe. But they still seem, I mean, they've got a 25/4 PE ratio, so it's still always too expensive for me.
Yeah, but I mean, they're 47 years of dividend growth, right, as well. And I owned McDonald's in the 5 years ago or something like that. I think I bought them for $94 at a yield of 4% at the time.
Wow.
And I sold it at 120 because I thought it was overvalued. And this is, of course, plain stupidity. But I was too caught up at the time in value investing in my mind. Although I called myself a dividend growth investor, I got a little bit like fear of height. And you need to know that in 2014, no, 2000, 2014, yeah, to 2016, we came just after the Greek debt crisis, and everything felt expensive. So it's a little bit, for me, similar to what we are feeling now after the crisis of the pandemic.
Yeah.
So yeah, then I thought like, yeah, it's overvalued. Oh, they didn't have the new menu yet at that time with the chef specialties. There was like no innovation in the menu.
Yeah.
Everywhere around me, I heard like McDonald's, you shouldn't go there. You had this movie on Netflix around McDonald's around that time. So that's why I thought like, okay, let's get rid of it. I'll buy some Johnson Johnson. So Johnson Johnson was not a bad decision, but when I see McDonald's now, I think like it knocked it out of the park with the menu changes, and that's why they're growing still their dividends at these rates.
Yeah.
Just a high quality company.
I mean, McDonald's are not going anywhere. every single kid in the country, in the US, in Europe, all know McDonald's, all love going to McDonald's. Even adults love going to McDonald's. Let's be honest. If I'm going away on a holiday next week, I'll probably eat McDonald's most of the time. I couldn't be bothered going anywhere else, but it's somewhere that you're familiar with and know. What's quite interesting, I'm looking at the industry here and it says hotels, restaurants, and leisure. Oh, where does the leisure come in? I'm not sure where that comes in.
I have no clue. I
Yeah,
really have no clue. Look, but I can tell you at that time, McDonald's was also struggling with their numbers. It was clear that the world at that moment was a bit tired of McDonald's. But you know what is always with these companies, specifically companies like McDonald's and such, they have this strong power to reinvest themselves. And the brand power is enough for consumers to give them a chance.
yeah,
Yeah, and that's what I underestimated there, and that's a learning, and it has prevented me from selling other companies that are maybe now a bit more overvalued.
yeah. Which is a good learning. I would love to own them. I really would, but I just can't buy them at the moment at current PE ratios. They just still seem a little bit too high, and their depth is a little bit higher than I'd like as well. Compared to the other companies on this list, it has the highest depth by far. But then we spoke, are they a real estate company? And then you would expect the debt to be a little bit higher because they're
Mhm.
using
Yeah,
that
exactly.
capital to buy real estate. So, I mean, top quality company. It's a company I wish I owned, but they are. I mean, 47 years of growth, and they're still giving nearly 7-8% increases every year. I think it's incredible.
Yeah, cool. So the next one then is Lockheed Martin. You know, they like wars, so I'm not such a big fan of it. But they had also a 7.7% dividend hike, all the way to $2.80. What are your thoughts about this one? I think you might know the company a little bit better than me.
Yeah, I quite surprised and quite happy with that. I think we did an episode, maybe 3 or 4 episodes where we did our watch list together. And this was on my list for September. I did actually purchase some today. Um, and I'm quite happy with that. To be fair, I think they're incredibly undervalued. Unfortunately, war never goes away. Their products are always going to be used. We know they have like some space endeavors as well, which I'm really, really, really excited about. And they have some serious numbers. Their growth over the last 10 years has been exponential. And as we said, they're in bed with the US government. That's not something that's going to change anytime soon. And they're probably looking to expand maybe more into Europe as well. So I think it's a well-rounded company. Just looking at their dividend growth figures, their 10-year dividend growth rate is 13.5%. That's incredible. It's far above. I typically look for 7 or 8%, and that's far above that. On top of that, you got good capital appreciation as well. So this isn't just focusing on dividend growth. The capital appreciation on this has been incredible too. So they have 20 years of dividend history, so they're 5 away from their aristocrat status. Maybe they'll take over from AT&T. Who knows? Um, but it's a company, I think, again, in a space that will always be around. It will always be needed. We're seeing aerospace taking off massively over the last while, particularly with the endeavors of Elon Musk and Jeff Bezos. So that seems to be heating up again. So I can see future growth there. So it's a company that I'm bullish on, and as I said, full disclosure, I bought some shares on that today.
Yeah, it sounds to me like I should give it another chance to look at it. If there's value, if my wife isn't paying too much attention, then I could always be interested in this.
You can always focus on the aerospace part of the
Yeah,
industry.
yeah, exactly. I think that's how I can pitch it. Probably she has never heard from Lockheed Martin because it's not a business to consumer brand either. So,
Yeah, yeah, and I think they've announced a $5 billion buyback scheme as well. So
ooh,
which is interesting.
I like buybacks at undervalued companies. Great.
Yeah, it's a good move. In my opinion, I think it's a good move.
Hey, then another dividend hike, and this one is also such a company that I don't own, but I would love to own because of the calculators, and that's Texas Instruments. They had a whopping dividend hike of 12.75%. I mean, this company is just rocking it, right? And over the last 6, 7 years, I run into Texas Instruments several times, often around 3% yield. And I felt like, oh, this is this boring company making calculator chips. Yeah. And then during the pandemic, with all this supply chain shortage, I started to look into it, and I felt like, fuck, why didn't I give it a serious look at it? Because it didn't have the sexiness like Nvidia around it or AMD, right? So those were always the ones that take all the attention. And I should have been counterintuitive because I love boring stocks. And I don't know with this one why I ignored the boredom of it, because this one's boring as hell. Yeah, and it's a perfect, really a perfect dividend growth stock.
It's exactly what we're looking for. And I wrote about these. These were on one of my another watch list that I had. I think it was August maybe, or maybe July. Um, I made a decision back then that, again, I'm always looking at these and they always seem overvalued, but I really, really, really love this company. So I wanted to own them. So what I'm doing is I'm buying in piecemeal. So I'm buying like 1 share a month, 2 shares a month, not even nowhere near like any sort of position size, but just adding to them slowly. So I think I'm up to six shares now. I think I bought 2 shares at the start of this month as well, and I'll probably do the same next month. So it's a company that I love. We know semiconductors. There's this worldwide shortage. We can they're safe. Semiconductors are going to explode. They're going to be used in absolutely everything. So Texas Instruments, in my opinion, is probably a good company to get involved in.
Yeah, and maybe for the statistics, 2.3% dividend yield. So the last dividend yield, now the hike was 12.75, but listen to this, on 3-year average dividend yield, 18.8%, 5-year average dividend growth, right? Sorry, 21.76%, 10-year average dividend growth, 22.75%. This
Wow.
is a hike on the low end. Yeah. So, and then if you think that it yields now 2.3%, if you do this, let's say multiply this by 1.15, you are talking really at a strong compounder here. And currently has a payout ratio of 57%. So you depend a lot at this payout on their earnings growth. But to be honest, with all the news that we hear, I don't see this company stopping anytime soon with proper earnings growth.
No,
It has all the tailwinds.
no, and think about this: that the share price was half, nearly about $100 2 years ago.
Yeah,
So,
thank you. Remind me about it. That was when the time when I was looking at Texas Instruments and thought like, oh, what a boring company. Calculators, calculators.
calculate who would have known calculators make so much money?
I had them at high school. They were perfect. You could write on the back in it with your, how is it? Not pencil with ink, but the other one, uh, crayon
Oh,
for the
crayon, yes,
French-speaking people. Yeah,
yeah.
and that was really nice because if you would only see it if you let the light shine on it, and then you could sneakily see the formulas which your math teacher couldn't see. And if you walk by, you put it like that so that the light didn't shine on it, and that was dark, and nobody would see that you have written something in it. So that's what Texas Instruments reminds me about at high school.
It reminds me of writing boobs on the calculator. To put-
Well, we can talk a bit about boobs more later in the portfolio review today. Texas Instruments and boobs. I never heard about that one.
Okay, we'll move on to one of your probably favorite companies. Again, it's a similar company for me with Texas Instruments. I added in piecemeal, but it's Microsoft. And there's no denying your love for the CEO or the company.
Yeah, it hiked the dividend by 10.7% to 62 cents per quarter. Dividend yield is now 0.8%. And what is interesting on social media, and specifically Twitter, I got the other day again, like, oh, this is not a dividend growth company. Maybe if you look at the investment case now, I can imagine why people say that. They treat it more as a dividend, as a growth company due to the revenue growth and such. It is a dividend growth company for me. I bought it for that reason. I have now I said an average cost yield on cost of 4.6% on this one. So for me, a 10% dividend hike is quite a lot of money then in the pocket, right? If you look at an absolute dividend income that I get from this. So for me, this is my strongest compounder. It is not my biggest payer from that point of view, but it's amazing. A payout ratio of less than 30%. They also announced a really huge, I think, 60 billion buyback on top of it.
It's incredible.
So this is just insane. I mean, literally, money is splashing like giant waves against their walls in the office. There, they just don't know. I think anymore what to do with their money
Yeah.
from the Azure and such.
I would happily take a company that is not a dividend company that is increasing their dividends by 10% a year. I mean, that's better than most companies. It's better than Lockheed. It's better than McDonald's, um, and it's only better by Texas Instruments on our list here. So I mean, what they're doing is incredible. It's absolutely incredible, and it's a company that I'm glad I got in when it was back around 200. I just wish I bought more. That's my
Yeah,
only regret.
I wish I bought much more at 40 when I initiated my position. Yeah, it's insane. I mean, the nice thing is one day this stock will trade at normal multiples again
Yeah,
from that point of view. That's what I've learned. Even Apple. Yeah, they thought like 3 years ago Apple is dead, no iPhone. I bought it at a PE of 10 to 13 or something like that. Look where it's trading now, and the growth it has seen afterwards. I'm sure there will be at a certain moment some headwinds from Microsoft, maybe also due to decreasing business performance. Stock market might overreact at that moment in time, and then with these kinds of payout ratios, you can just double down on such a stock. It's amazing.
yeah. I mean, software is constantly changing. It's a dynamic industry, and if you're not moving forward, if you stay static at all, which Microsoft did for a period of
Yeah,
time,
exactly.
it you can be blown away by your competitors. So, I mean, look, it's hard for a company to always be on the forefront all the time. So I would expect them to pull back at some point. But
Yeah.
I mean, there's no denying that they are a one of a kind company.
So the advantage that Microsoft has is a similarity as SAP. If you pull it out of a corporate, the corporate cannot operate effectively, and that's their advantage at the moment. And it's not easy to switch your technology in a company away from Microsoft. These are multi-million investments typically, so they have a really strong lock-in, and just maybe the cloud business is in some cases easier to switch from switching cost point of view. But generally, if people would stop using Microsoft overnight, they will be in trouble. Most of the companies.
Yeah. Okay, so we'll talk about the last company on our list, which is Altria. So take our MO. And I'm glad we have this on our list because we can see quite rightly this is a declining business, isn't it? That sector is declining. I know they've taken chances trying to go into other avenues, but tobacco at the moment is something that's not going to grow at a fast pace, and we can start to see that in their dividend increases. So if you look at their history, their 5, 10, 15 year history, it's always around 8, 9%. This year we've seen it's down around 4.6. So it's already declining. We're starting to see revenues declining as well. So it's important for investors, I feel, to know, okay, this has a high yield, high starting yield, but the growth in dividends is probably not going to be what it once was. And it's probably a warning sign. If you're buying this for dividend growth, you might be better off to look at some different alternatives. It's there for a high starting yield, but it's certainly not the dividend growth stock it used to be.
Yeah, I think so. With these kinds of companies, I think they might still have like 10 years in front of them, right, of dividend paying. So I'm not too concerned from that point of view. I'm actually more curious of what these companies will transform into. I spoke with someone from tobacco industry the other day, this week, And I said, from the tobacco company. And said, you cannot call us a tobacco company anymore. You cannot relate us to smoking, because we're really transforming into also into pharma and such, where we're thinking, because we are great, we're great at creating production products which allow you to inhale stuff. Yeah. So I was, of course, laughing because it sounded too hypocrite. However, there's truth in it. If you look at their core technologies, yeah,
Yeah.
if they can use these technologies to actually also save patients or create diagnostics equipment and such, there might be a whole new line of business for these tobacco companies, because there are core competencies in these companies that are quite unique, that you might, for instance, apply to pharma as well.
Yeah.
And this is where my curiosity is around tobacco stocks. We also know that Bats is looking, I believe, at was it vaccines or something like that they were
Yeah.
investigating. So it's will be really interesting to see how they transform over the next 10 years.
Yeah. Yeah. We've seen all three to get involved in cannabis, to get involved in Jewel, I think, which is not as successful as they thought. And I mean, cannabis is such a high risk strategy. We don't know where that's going to go. Is it going to be legalized? How's it going to be taken up? I mean, I don't know. For me, the pharma route is probably the most safe and secure route for them to go. But like you, it's interesting to sit back and watch. I am a shareholder of both Bats and Altria, by the way. I still like the companies, and like you, I don't think they're going anywhere over the next 10 years, but they certainly do have to start making efforts to pivot into something more sustainable.
Yeah. Good. So these were some of the dividend hikes. We really want to discuss a little bit about it. If you're listening and you like these kinds of themes for our show, then just let us know. We can do this more often, for instance, on a monthly basis. Let's go to one of our newest sections that we actually get a lot of positive feedback about, and that's a portfolio review. And we have still a few people in the queue, actually. People are coming voluntarily to us to submit their portfolio. So if you're interested, just drop us a note, EMF or myself, or via the Dividend Talk Facebook group. We put them on the backlog, and we'll make sure that we address it in one of the upcoming shows. So today we will talk about the portfolio from Mark Van Essen. He submitted a few weeks ago. And let me explain a little bit what this portfolio is about.
Okay.
So his goal is to retire early in about 8 to 10 years' time. And he likes to have a portfolio with mostly value stocks that pay a dividend. He loves real estate investment trust, around 1/3 of his portfolio, and he usually owns about 35 to 40 stocks. He wants to find a balance between defensive and sometimes a bit more risk. So keep this in mind. And from that point of view, his top 5 are, first of all, British American tobacco. Oh man, English American tobacco, 6.2% size. I think then ticker Star is iStar, 6% portfolio size. And he likes it because they have a quite a large share in Safehold. Then the third position is Ahold Delhaize with a 6% size. His fourth position is Vici Properties. So they own a lot of real estate in Las Vegas, I believe even the Caesar Palace, with 5.7% size. And then the fifth one is Unit, also a real estate investment trust with 5.4% portfolio size.
Cool. So my initial reaction on seeing this is I've never heard of a couple of those companies. So ticker Star, which I believe is the company's called iStar, Vichy and Unit, which are all REITs. So maybe Dividend Dane might be best to give his thoughts on something like this, but I don't know anything about them. I just looking at Yahoo Finance and just looking at basic metrics, and typically I feel investors invest in real estate investment trusts because you get a high yield. So they pay out a large amount of their money by law, and you get a nice percentage of that back. So typically anywhere above 3, 4, 5%. I look at iStar, and their forward yield is 1.95%, which is way lower than I would expect from a REIT or would want from a REIT. So he mentions that he's looking for value. I don't see much value in companies like this. Similar with British American Tobacco or English American Tobacco, as you called. I mean, the company does seem cheap in terms of dollar value or pound value, whichever exchange you bought it on. But I wouldn't consider them value based on that because they are inherent risks. We just spoke about that actually a couple of moments ago on Altria. We know that there are risks in the tobacco. It's a declining industry, so I don't see value. I don't see these stocks being what his goals set out to be, in my opinion. I don't know enough about, as I said, the real estate investment trust to give an honest opinion of are they good companies, are they not? But certainly as a top five, I think this is a little risky for my liking. I would much rather see someone like WP Carey there, or even Realty Income, which are high quality REITs, I suppose, compared to some of these.
Yeah, I've got similar thoughts around this portfolio in the top five. So British American Tobacco for me is clearly a value at the moment. Yeah, it's for me undervalued. It pays a really good yield. So if he wants to retire in 8 to 10 years' time, I think it might be there. There is a catch here, though. British American Tobacco will never trade at a high multiple when ESG investors, minded investors, are ruling the index funds at the moment. Yeah, that means also that British American Tobacco will most often not be included there, so it misses out on a lot of volume and growth from a price point of view. However, the dividends will be juicy; they are safe from that point of view. I looked into also some of the real estate investment trusts. I know Vici a little bit here. I looked also at unit, yeah, and then the dividend history is one of the things that straight away comes into my eye. I understand what he says between defensive and sometimes a bit more risk, but I would take risk on. I said I'm like you. I miss quality in the top five as a core, as an anchor, as a foundation of your portfolio. I see most of those, even when you think about defensive and sometimes a bit more risk, I couldn't see them if for myself as an anchor in the portfolio. There are other stocks, like you could say that Unilever has some risks here, right? Hedge funds are looking at it as an example because it's not unlocking enough value here. And of course, it's not a real estate investment trust. It's more like consumer staple. Maybe I'm biased towards those, but I'm missing a little bit this feeling of this is a strong core, and there may be some risk related to it that the value that they are therefore undervalued. But yeah, no, I would have expected some other real estate investment trust in here, like Realty Income or something like that. To your point.
Yeah, I just get the sense that there's a misalignment between the goals and the top
Yeah,
five.
yeah, yeah, exactly.
So the goal is to retire in 8 to 10 years' time. Okay, and we expect a little bit of risk, and I have no problem with risk to get there. But I don't see the reward in these companies. So take a company, Vichy, ticker VICI, for example. The stock price has been static-ish over the last couple of years, so we haven't seen much of an stock price appreciation. So you're not going to reach retirement based on stock price appreciation. And also the forward yield, I mean, it's quite low. So for a REIT, like, so I would rather see higher yield or much rather see price appreciation to reach those goals. So I just think there's a little bit of a misalignment. But again, I'm not fully aware of these three companies, so I could be completely wrong on this. And actually, I would love probably to hear Dividend Dane's thoughts on these three, because he might tell us that we're talking absolute baloney, and these are three actually really good companies to have in the top five.
Yeah, that's true. Well, Mark, those are our thoughts. You have to do it with that, of course, but you heard us talking a little bit. We have some assumptions under our feedback, so feel free to challenge us and to share your thoughts with us. We are easily to be influenced and to change our minds, so don't worry. But yeah, feedback is a gift. So yeah, uh, I hope it helps you in further in your I said in your goal to retire early in the upcoming 8 to 10 years.
Yeah, I really hope you get there. And when you do, pop me a message and tell me I was wrong about your top five.
Yeah, exactly.
Okay, cool. So we'll move on to questions from the community. And the first one is from Kurt. And this company has come up before, and every time it does, we get lost in the annual report. It's a great annual report to read. I recommend it to absolutely everybody. But the question is, please have a second look at Van de Velde. So the ticker there is VAN.BR if you're looking on Yahoo Finance. And he's just saying that he's mentioned this company before. It has surged 25% since he has mentioned it, which is true, by the way. He gives it a value of about €40. What value would we give it?
Well, I can tell you, their mission of the company is shaping the bodies and minds of women. And then, I mean, again, I opened up the annual report and I just see boobs. And I can tell you, every time I see it, something else is surging 25% here. And I mean, that's what I just think when I look at this company. So they say price is what you pay, value is what you get. I cannot tell you if it's 40 euros, but I wouldn't mind paying 40 euro just for reading the annual report. And if I get a stock with it for free, then it created already a lot of value for me.
I mean, I don't have too much more to add to that, but what I can say is fundamentally, we have seen them cut the dividend before. So yes, they develop, I mean, fashionable brands. It's luxury items, and it's going to do well when economies are doing well. I feel like it's a company that might not do so well when economies are not doing too well, and I have a feeling that that might happen sooner rather than later. I mean, it's not. Look, I'm happy. The price has gone up 25%, but for me, it's not a company that I would personally be investing in. I have other ideas on companies like that, but I mean,
Yeah, it's not a dividend growth stock, right?
yeah,
Because it lacks the dividend history and the dividend history reliability. So it might be a really good investment from a valuation point of view. But that's a small part of my portfolio as how I look at it. So and then I rather invest at the moment at Alibaba or something like that
yeah, yeah,
without
and
the boobs.
yeah, I have to stress that it's not part of my strategy. Like, I'm mainly a dividend growth investor. Obviously, I do have other investments as well, but as you said, this just doesn't fit the bill for me. So, Kurt, I'm happy. I'm happy you've gained 25%. Maybe I don't know. When do you plan on realizing some of those gains? Is my question to you.
Good. Phil is second today. Yeah, Phil, you need to step up a little bit to become first again. So he's asking, following the toilet paper discussion, question about your consumer behavior, but linking it to investment taste. When it comes to buying products, do you tend to buy known brands or no-name products? Is it the same with stocks?
Oh, that changes, and it depends on what the occasion is. Um, I suppose to put that in the context, if I was buying clothes, if I'm just buying clothes just to go around every day or just to go into work, I don't really care what brand I'm wearing. But if I'm going, I don't know, if I'm going to a wedding or going to something a little bit more tasteful, I tend to go for brand and comfort. And I suppose the same is probably said for stocks. When you are overpaying, I tend to want to buy the likes of Microsoft, Texas Instruments. But if I'm buying companies like Walgreens, for example, I'm buying them at a bit pricey, at less price, and they would not be what I would consider a premium brand.
Yeah. Okay, cool. Next one is from Thiago Diaz, and he asks, should index funds vote in shareholder meetings? If so, how should they vote? Whatever the fund manager wants, or make a poll to the investors in the index fund? Any other way? So I think generally that a company like BlackRock should withhold from their voting rights, or as per the suggestion of Thiago, do a poll among their investment or among their customers. And why I think BlackRock is not a company that can represent the voice of the shareholders when you're selling ETFs. Although in some companies they might have like a 10 or a 15% stake and therefore a really large voice. That's why I think they should either withheld or figure out a process to really get the insights of their customer base. I think the second one is almost technically impossible. So I think that a company like BlackRock should generally withhold themselves from voting. I know there's like this ESG kind of topic at the moment of doing good for the world, but I don't want corporates who are unelected officials to decide for me what's good in the world and what's bad. For that, we have a political system. For that, we elect people and we get them empowered to make the right choices. I think BlackRock is a business. It should stay away from that. I think like Unilever, I have another feeling with it because it makes a choice as this, and it attracts a certain investment category of people. But this is about index fund investing. So
Yeah.
here it's more at Unilever, I'm the one who can vote, and at BlackRock, I can't vote if I'm in the ETF, and BlackRock shouldn't hold that against us.
But you invest in a managed fund. Why? For somebody else to manage and to make the decisions on your behalf. So why would they come to you
But
then?
this is not the philosophy of index investing. This is not a managed fund like that. It's just a tracker.
Yeah, it is just a tracker, but they still have to manage that tracker, don't they? Like the shareholder investing in these funds, they are not looking at each individual company. They're just throwing it into a fund. So I don't see why they would have to go to the investors
Okay,
for it.
let's say like that. I would agree with that if their policy really writes what along which lines they typically vote and what they are against. Then it needs to be clear that BlackRock says everything that's good for nature will push through on the agenda of the shareholder meetings or something like that. Then I would like to see a clear thoughts line of principles along which lines they vote, because you do. I said technically you don't own a vote, right, as a shareholder, but you're still via an ETF buying a piece of a company, and although you might technically not own it, I believe you do own it because that's how the model has been designed. So I think it needs to live according to that model.
I'd probably disagree. If you want shareholder rights, invest in the company directly. You don't really own the company through a fund, really. I mean, you have tiny
I
percentage,
I
fractions,
know,
fractions.
but if yeah, I know, but that's why this is I said a thought-provoking question.
Yeah, there's a good question. It's a tough one, but I mean, it's
You know where it comes from. If you really look at the data, BlackRock owns the world. So you get the world. BlackRock, if they want, they can change many management boards and exercise a lot of power in the line of thinking in those boards. And I think this is kind of the I said this is kind of philosophy that pisses people off when they think about it, specifically if you're skeptical around such topics, which I also have some skepticism then there.
yeah. But what you basically said to me there in a nutshell is I need to start buying shares in BlackRock. That's basically what
Yeah,
you said.
exactly. Yeah, exactly.
Okay, cool. Thanks a million, Tiago. As always, hard questions that make us think a lot. Thank you. So the next question is from Jilly, and they have asked us to explain how to manage the taxes as efficiently as possible with dividend investing. And look, I suppose we typically don't do disclaimers. We have always said we don't give tax advice. We don't give any advice at all. This is like a pub chat. We cannot really tell you how to manage tax efficiently. I don't even know where you're from. Europe is big. There's different rules. If you want to manage it efficiently, just talk to an accountant. That's what I do. I have an accountant. My accountant looks after my taxes. So I would certainly recommend something like that. Um, as I said, depending on where you're from, that will be completely different. It's different for me as it is to European DGI. We're in two separate countries.
But there are just two things that maybe are good for Jilly to think about. If your country provides you with an retirement savings plan where you can, like an Roth IRA or something like that, or 401k, you could consider investing in it. Please look at the fees, because maybe it might be tax advantages. But if you then, if the commissions eat away your performance, then you might even wonder about that. Also think about whether you want to withdraw the money before the retirement date. So you need to look at all those policies there, but that might be something for you to consider. Second, just ask your money back. Yeah, it's really simple. If you buy German shares in Germany, just ask the money back that you paid too much. Yeah, there are the treaties. Yes, it costs you some admin work, but one thing we shouldn't always forget as investors, we're at the starting point often here, like 4 or 5 years, so the amounts are not so big. But if you're 20 years down the line, you're probably talking about thousands of euros in dividends. By then, it really, really helps you to, and it's really, how you say it, profitable to ask the money back. So those two I would say. And then the last advice I have is, or recommendation I have, or which I apply: don't look at companies when you invest in the tax adjusted yield, and don't be blinded just by the tax rate of a country, because you might miss out on some great businesses.
Okay. The next question is from Odysseys, and he says he loves the music at the beginning. Who chose the music, and is it composed by any of you?
Yeah, I can tell a little bit the background behind it, because this was just the first show. I bought a license in Filmora at the time because we wanted to do it a bit also with YouTube visuals as support. I paid $80 for it, but what every listener needs to know is we're doing this for free. We don't have any advertisements. We don't have any sponsorship. We're just two guys having a pub chat Friday evening while wives are bored behind the TV because we're not with them, talking about investing. So that's why we don't want to have any costs as well. We have Filmora as a license. That's probably it. We might maybe have somewhere still a domain name set up. That's really it. So from that point of view, you just look at Filmora and you look like, okay, what is the free music you can get there? There were a few in there. I just took one of the songs, cut off 3 4 seconds, and then you get this tune. And what I now learned is that it's addictive and it sticks into people's mind, which was not planned. You must think, like, if you ever do for the first time yourself editing something, that's the level. So this is just a coincidence here that we end up with that. I will look up the name of the song because I know the song is on YouTube, and I will share it with you, Odysseus, so that you can put it on repeat continuously on Spotify or something like that.
Nice. Another question from the runner, and they have asked us what to do if one owns a sizable amount of GSK or Within a Gas. Will it be impacted by the recent Spanish government decisions? For me, I would consider why you own each of those companies, and if you feel like the government will impact them, then sell them. I believe, particularly with Enagas, it will have some impact. We know with utilities like this that governments hold a lot of power. There's always political pressure on things like this, so we might start to see some impact. But GSK, I'm not too sure on. But with Enagas, I recently sold my position in that. But I suppose it's up to you what you think on the Spanish government.
Yeah, the only thing I can say on top of that is, like, what I have with my portfolio is that none of my so I've got a 4-tier system, and it classifies and tells you the sizes of the brackets. So I can share with you the link to how to set that up in your portfolio, and that tells me whether I've got a sizable amount or not. If it's going far above, I would consider trimming it. I know that I believe GSK had no any dividend hikes for quite some time, but it has a fat dividend yield. This company has been already a question mark for me for the last 5 years, and that's why I never invested in it. And I guess, and the gas prices at the moment, I think it's continuously a risk. I'm still in it. It's a really small position for me, so I'm not too worried about it.
You get a juicy dividend yield for that risk as well. So
Exactly. And then maybe the last question for today for you, EMF, and it comes from Casper Kornak, and he says Shell sold an oil field for 9.5 billion. Is this a good move or not?
I mean, I think it's a good move. I think they sold it to, is it Permian in America, and I suppose we are starting to see a lot of pressure from European companies like this to sell their oil and gas production as they move to more cleaner, sustainable. We know Shell are trying to pivot into green energy, more sustainable. So this is part of that process, I would imagine. They're selling a business with probably a lower margin than their core business. So look, I think it's a good deal. They're getting a nice amount of money for it. It probably suits both sides and gives them more money to reward us shareholders with buybacks and dividend hikes.
Exactly. And speaking of which, did you read the news that Total Energies is going into a joint venture with Volkswagen and another company to build a battery factory?
Oh, I didn't read that, but I did see that Volkswagen are ramping up their
Yeah.
electric car gig as well.
So they are going to do a 7 billion investment. I think Volkswagen pays 1.1 billion in there, and the rest is split between the other two companies, of which one is Total Energies. The thinking behind it is that Volkswagen brings a lot of the know-how as well into it, and the others they bring capital into it, and it allows them also to learn from the know-how and to get into this business. So for me, that's a really interesting development, and it's one of the first oil and gas companies now that we literally see starting to explore battery production.
Yeah, and look, battery production is going to be huge, I think, particularly when we move to these smart grids across Europe. I know we have
Mhm.
some smart cities in Europe, but as whole countries start moving to this, battery technology is going to be pretty pretty useful, and especially in electric cars. I know they were considering vanadium at one point. They still have lithium, but what do we do with lithium? You can't dispose of it too easily. So we certainly need to dig a little bit deeper in our technology and get longer lasting batteries and ones that we can sustainably dispose of when needed.
That sounds like a wonderful ending for the show today, EMF.
It sure is. Thanks a million to you as always. Thanks to all our listeners. Check us out on Twitter, Facebook. Check you out on YouTube as well. We're on pretty much all platforms. As always, get in contact with us. We're happy to reach out to everyone. So thanks again, and we will see you all next week.